Hello and welcome to this special edition that you're watching on ET Now. We are all on standby for the first quarter GDP numbers to be released. It could be out any moment from now. Consensus seems to be around 13%. Remember, there is a low base effect at play. A year ago, it was a second wave of COVID-19 that had resulted in a lockdown. Now, just before we get to the GDP number when it's released by the government, with the information that we do have and some other macroeconomic data that we do have, the core sector data is out where we have seen a slowdown. Core sector output has slowed down to 4.5% in July versus 9.9% year on year. In fact, I've just got an alert from my producer. There's breaking news. The numbers should be on your screen. The first quarter number is out. India's GDP number for the first quarter has come in at 13.5%. Pretty much what the consensus was. I'm very soon going to be joined by our experts. I believe our consulting editor, Maithili Bustermath, is already here with us. Maithili, good evening. This is Nentara. You and I working on Ganesh Chaturthi, as is the government that is releasing this macroeconomic data. 13.5% for GDP. Pretty much what the street was expecting.
I think the street was expecting a little higher, frankly, because the RBI's estimate was 16.2, and most estimates, though they were between 13 to 16%, I think the hope was that it will be somewhere closer to 15%. So 13% does come as a bit of a disappointment. Of course, the fact is that last year one can't compare with last year's numbers, because last year's numbers were, artificially bumped up by the previous quarter's contraction, the previous Q1 of the previous year, because that was the worst year of COVID. But we'll have to see the internals to see where has this growth come from, because even at 13%, if you compare with what the other countries in the world have done in their first quarter, well, the US, the UK, they all contracted. The IMF said the global GDP has contracted. So by that yardstick, 13% certainly does look quite impressive and quite encouraging. But do we have our guests with us, Swagato, Radhika, and Ashima with us? Okay, so let me just go on now to Swagato. Swagato, what is your first reaction? Your estimate, I think, was a little higher, right? Somewhere in the range of 15%. So are you disappointed with this number?
Well, thank you for having me on the show, Maithili. So, disappointed is a strong word. We were certainly higher, upwards of 15.5%. So in that respect, it's a little, but I mean, our estimates of construction, and particularly trade and hospitality, that particular segment was driving our high growth numbers. I mean, from all the high frequency indicators that we had seen. So my own bet is once you get the internals, the very high numbers that we had assumed for the trade, hospitality, and even to a certain extent for the banking sector, financial services. So those probably will have been a little higher, but yes, I mean, a little bit lower than what we had expected.
Radhika, what were your estimates like? Were they in this range of 13.5, or were you also hoping, like Swagato and RBI, that the number would be a little higher for Q1?
Hi, good evening. Mine was also on the higher end of the consensus range, and the breakdown, I mean, even at 16%, 15.5%, 16% on the headline, sequentially or quarter on quarter, it would have been a contraction. But I think with the 13.5, that suggests that the contraction would have been deeper. I think what we need to really look at is the breakdown, and I would assume that despite a slower pace of headline growth, the source of strength would still be services. Base effects have really, played havoc with the numbers in the past 2 years, and I think fiscal 23 will perhaps be the year when we'll see most of it, and then 24, 25 onwards, it should settle a bit. But certainly on the, in terms of the drivers, I would think it would still be services, because that is the sector in particular that saw significant opening in that period. The other thing I want to watch is also agriculture, because obviously we had seen early heat waves, rainfall that was quite early on, so it wouldn't have captured it fully. But certainly the impact of heat waves and the impact on wheat output, that could have been one of the reasons why farm output would have been slower than our estimate. So I assume these are what the breakdown will reveal, but we'll certainly look at the numbers more closely.
Well, yes, we are awaiting the internals as yet, and hopefully we will get them soon. But we've got core sector number, where the core sector growth has slowed down. So does it mean that going forward that we will see the inevitable slowing down of GDP? Because if you look at India's GDP growth trajectory over the quarters, historically the first quarter has always been the best. And then subsequent quarters have seen a steady slowdown. Of course, the COVID year was an exception because the first quarter had such a huge contraction that the subsequent quarters they showed some improvement. So as we progress this year, do we expect to see the same kind of slowdown? Because RBI's estimates also progressively see a substantial decline. The last quarter for them is only 4.0. So Sogato, are we in for a slowing growth? How much slower? Sharply lower? Or just moderately slower, Sogato?
No, so Maithili, actually sharply lower. So we were expecting a 15%, 15.5%. Now it's 13 and 13.5. Then the next quarter, we are presuming a 6.1, then a 4.1, and then a 4.8, with an overall growth of around, I would guess now about 7.1 to 7.2 for the year. So the sequential momentum, or at least the sequential prints, if not the momentum, is slowing. I'm not very sure. So at 13.5%, I would presume that in quarter one, India's GDP would be about 106% above the pre-COVID, the Q1 of FY 2020, the pre-pandemic level, about 106%. So that's the basic status of where the real economy is in now. The nominal side is very different. The nominal picture is very different, but that's where the real picture is.
Ashima Goyal, who is a member of the Prime Minister's Economic Advisory Council and also a member of the MPC. So Ashima, are you disappointed by the numbers, the first quarter growth? They're a little disappointed.
The base and momentum effects and the pandemic effect and now the Ukraine war. So it's very difficult to infer anything from a 3% difference, or especially when between 13 and 15%. I think one of the major factors that could have led to some slowdown is the slowing of export growth, because export minus imports has become more deeply negative over this quarter. But we need to look at the breakup. Consumption, is investment holding up at all? Also because that Q1 was the one where we had Delta last year. So momentum, the sequential contraction is worrying. So, the RBI projections did not impute any slowdown, despite the rate rises. The projections stayed almost the same. So this suggests that with the rate rise, we need to see if there is some effect of that on, say, construction activity. So we'll have to look at the data more carefully.
Of course, we have to look at the disaggregated numbers more closely. But Ashima, as you said, the first quarter was also marked by a decline in export growth. In the months ahead, exports are not going to do very well. That is very clear, both from the recessionary tendencies in the Western world, as well as the fact that there's a growth slowdown across the board. So how much do you expect exports to contribute at all? My understanding is that last year, almost 50% of GDP growth came from exports. So where are we going to see that support for GDP in this fiscal?
You see, the support for growth comes from net exports, that is export minus imports. So because of the hardening of oil prices, the contribution of net exports went down, even though export growth was quite healthy. Yeah. But overall, we will see some slowdown in export growth also, and it depends on oil prices, what happens to imports. And then even non-oil imports were growing very, very strongly. So overall, we do need some demand compression in the economy. Maybe we are seeing the beginnings of that.
To get inflation down, then which are the four drivers of growth? That is private consumption, private investment, government expenditure, exports. These are the four main drivers. Now, which of these can possibly support growth, particularly if, as you say, we need to suppress demand in order to get inflation down? So is there going to be a huge demand sacrifice because we were slow to act on inflation?
No, I don't agree that we were slow to act on inflation because given the structure of the Indian markets, you need to withdraw liquidity to some extent before you could start raising rates. We started withdrawing liquidity much before, say, the Fed has even touched its balance sheet. And at least the RBI started withdrawing liquidity well in 2021. And now when the interest rate rise came, it was front-loaded. So, and with forward-looking inflation, we are already at positive real rates. The deviation in real rates was never very large, nor was the broad money supply growth, because the banks were just parking the money in the reverse repo. So broad money was not growing. It was not that money was driving inflation. So the big kick for inflation came from the Ukraine war and the oil price increase, to which the economy is very susceptible. And here there is a limit to what demand contraction can do. So the coordination in monetary fiscal policy, the government acting on its size. If you see, WPI inflation is much higher than CPI, because WPI is straight away impacted by international prices, oil prices. While CPI, it's mediated by what happens to taxes. Yeah? So the CPI growth has been contained, and it's the peak. After the peak in April, it's been coming down, which is very healthy in the circumstances. And 1 year ahead, it's expected to be 5%. Without much growth sacrifice.
Radhika, I would like to come in here, and but when I look at all the macro data that is now coming out in the internals, this one I can't get over. The April to June manufacturing sector growth is at 4.8%, as against 49% year on year. How should one see this figure?
9% was really because of the steep fall in 2020, right? So as these base effects moderate, you would expect growth to come down to more reasonable levels. But 4.8 is still healthy compared to, in some quarters we had 2% and decimal growth. So manufacturing is holding up. That's one of the things we need to see. Private consumption, manufacturing, government consumption. These are what can support growth if net exports becomes negative.
That base effect that was at play. So Radhika, another question to also ask, and what a lot of our viewers will want to know. We now know the first quarter GDP numbers. We know what the RBI has been projecting. We have all of those assumptions. Will you at DBS Bank stick to your yearly growth forecast?
Thanks. So certainly, I think the first quarter GDP numbers now are a bit lower than what we had as a starting point. And I think even given us a higher starting point, we were expecting the subsequent quarters to slow down, to come below 6% and eventually closer to 4.5% by end of the fiscal year. Now with a weaker starting point than what we had anticipated, I would think there are slight downside risks to our full year growth forecast, which is at 7%. A bit lower than the central bank's projected number. I would think that this does add a bit of downside risk to our full year number. But of course, we will take stock, now that the data is out, to understand where the stock of weakness is. And because, of course, I think in the first quarter, like Ms. Goel already mentioned, there were a lot of political reasons because of which there was impact. There were also commodity prices that were much higher. But going into the second quarter of the fiscal year, we have seen some of those pressures a bit. On one hand, on the other hand, we have seen the monsoon, which there's still at least cumulatively it's above the long-term average. But if you see some of the crop divisions, we've seen a bit of uneven rainfall, and in paddy in particular, there's a bit of gap compared to what happened last year. So there are some risks that have abated into the second quarter, and there's some fresh risks that to keep an eye on. But the good part is that the economy is as open as it can be, and there will also be this festive bounce in the second half of the year. So those are positive factors. But I think overall, when you see year-on-year numbers, partly because of distortions from base effects as well, we would think there is a slight downside risk to our full year growth forecast of about 7%.
And I'll pose the same question now to Shaugato, who's joining us from Axis Bank. We've heard from DBS Bank now that there could be some threat to the yearly forecast. What about you, Shaugato? After this 13.5% number, your yearly forecast, what is it, and do you think it'll be safe?
So Nandara, again, I think it's still too early to hastily revise our forecast. We were, as I said, 7.3% for the full year. It depends on how the growth impulses are really distributed across the 4 quarters. RBI has been, for a fairly long period of time, has stressed the first quarter as a big single engine of overall yearly growth. but we wait to see. One for one, apart from all the other drivers, I think government investment is likely to be a very significant driver of growth. And particularly if more capex comes in, more transfers to the state governments on the conditional capex disbursements to state governments, etc. All of these come in. The asset monetization problem, the pipeline comes alive. So all of that is still too early. The second point that I would like to mention is imports. Because again, as Radhika also mentioned, that this is export minus imports. And imports growth had been very, very high over a significant period of the last year. And particularly the fourth quarter of last year, and to a certain extent, even the first quarter. So now that we have seen commodities, energy prices come off, if the import elasticities don't offset the fall in our crude imports, that is likely to be another growth driver. Whether it's a technical point, but that again is going to go for the third point that I would like to mention is the GDP deflator. Because remember, with the very high WPI prices, the high nominal growths that you have are also deflated fast. So now if the WPI comes down and CPI is more or less at the same level, so that's a third driver that might actually push real growth up. So there are a lot of moving parts in this. So as of now, we're still maintaining 7.3, but there are certainly downside risks.
Well, yes, yeah, there are many downsides, but fortunately there are some upsides too. But I'm afraid it's time for us to slip into a very short break. So please stay with us, all three of you. We'll be back very, very soon.